Whether you are a long-term investor or a short-term trader, understanding the earnings expectation life cycle and where a stock lies in the cycle is important for knowing when to buy, sell, or hold the stock, and how it is likely to react to earnings announcements. The concept was introduced by Richard Bernstein, the former chief investment strategist at Merrill Lynch, and discussed in detail in his 1995 book, Style Investing. It is based on the idea that corporate profits move in cycles, with periods of growth and decline, and that these cycles can be used to make better investment decisions. To simplify this, it comes down to just two factors: earnings and expectations. The left and right hemispheres of our cycle diagram represent the direction of earnings. As financial news commentator Larry Kudlow used to say, earnings are the mother's milk of stocks. And there is a statistical correlation between stock prices and earnings estimate revisions. So when earnings are trending higher, it generally pays to be a buyer of the stock, and stocks with upward trending earnings estimates belong in the left side of the diagram. Stocks are on the right side, or the declining phases of the life cycle, when earnings estimates are trending lower. You generally want to be a seller of stocks in the right hemisphere. Of course, it isn't just an earnings life cycle, it is also an expectation life cycle. In our diagram, the top and bottom hemispheres represent bullish and bearish investor sentiment. When sentiment is bearish and fundamentals are trending lower, stock prices are their weakest, but once the fundamentals start improving, it catches investors by surprise, forcing bearish traders out of their positions and bringing new investors into the stock. Therefore, you have more upside potential in the positive earnings surprise phase because earnings estimates are just beginning to turn higher and most investors either don't believe it or are caught by surprise by the change in direction. The positive surprise phase of the earnings expectation life cycle is when most of the post-earnings announcement drift occurs. It often takes more than 1 quarter to transition to the next phase of the cycle, but in this example, the stock gaps higher on the positive earnings news and buyers step in, initially following the results. This drives the stock higher. As the quarter nears the end and the next earnings release date approaches, investors become more optimistic and sentiment improves. This drives the stock price higher going into the next earnings release as well. The upper half of the diagram represents bullish sentiment, but this can be a positive or a negative for the stock. As the commodities trader Ed Seykota said, fundamentalists figure things out and anticipate change. Trend followers join the trend of the moment, so the difference between the earnings momentum phase of the life cycle and the positive earnings surprise phase is primarily the fact that the crowd has caught on. Those that catch the change early are the ones to make the most money. But most of the money is made in the earnings momentum phase because this is where the long-term upward trend comes, and no one knows how long a trend will last. However, as long as investors are bullish and earnings estimates are trending higher, stocks tend to continue higher. Eventually, though sentiment reaches a peak, expectations get too high, and the company misses estimates. As the commodities trader Richard Dennis, the Prince of the Pit, once said, markets, which are often just mad crowds, are often irrational. When emotionally overwrought, they're almost always wrong. When sentiment is excessive, an earnings miss becomes a signal to sell and often marks the beginning of a longer-term trend lower. For example, this is a chart of Abercrombie & Fitch from late 2019 until near the end of 2023. The shaded mountain in the background shows earnings estimates for the company, which typically change with each earnings announcement. The gold line in the middle chart shows our measure of investor sentiment, ranging from 100% bullish to negative 100%, which would be 100% bearish. Using this data, we've color-coded the chart to match the phases of the earnings expectation life cycle. The long downward trend of a stock tends to occur as estimates are trending lower and investors are bearish. It is called a value trap because the stock looks cheap by most measures, and contrarian traders look to buy out of favor stocks, but the fundamentals continue lower. driving the stock lower as well. For Abercrombie and Fitch, the stock was a value trap from the very start of the chart until August 2020, when the company gave forward guidance below estimates, putting a red arrow on the chart. But the company also reported a surprise profit, and this marked the bottom of earnings estimates. While we have a red arrow on the chart to show the negative guidance, in August of 2020, while investors were still bearish the stock, Abercrombie and Fitch reported earnings of 23 cents per share, while the earnings whisper number was a loss of 85 cents per share. The stock closed higher by 8.1% on the news with its highest volume of the past year, creating an earnings spike and the start of a new trend higher. This represented the positive earnings surprise phase of the life cycle because investors were still bearish, but fundamental trends were moving higher starting with the earnings release. By the time the company reported earnings the following quarter, investors were becoming bullish and the stock was up approximately 80% during the quarter. Abercrombie and Fitch entered the earnings momentum phase with its November 2020 earnings released because investors turned bullish and earnings estimate revisions continued higher. For the quarter ended in October 2020, the consensus estimate was a loss of 5 cents per share. The earnings whisper was a profit of 8 cents per share, but the company reported a profit of 76 cents. This solidified the upward trend in earnings, accelerated the analysts' estimate revisions, and started a fundamental trend that continued through the end of 2021. It took over a year from the time investors became bullish the stock until estimates finally started moving lower, and from the November 2020 earnings release until the peak in late 2021, shares of the stock doubled. Investors and traders that got in during the positive earnings surprise phase made the most money, but there was still a long stretch in the earnings momentum phase to make money. Nothing works perfectly and nothing works every time, but eventually, the bigger trends tend to win out. In this case, the company missed the earnings whisper of $1.34 by 20 cents in early March of 2022, and estimates started moving lower. Investors weren't convinced, and the sentiment remained bullish, moving the stock into the negative earnings surprise phase of the life cycle. However, when the company reported earnings the subsequent quarter, it not only surprised with a loss, it also lowered its guidance. The stock traded lower by 29% for the day on heavy volume on the chart. This resulted in what Richard Bernstein called a torpedo. From there, sentiment continued lower, as did earnings estimates, but it still took another quarter before investors turned bearish. It wasn't until the following earnings release in May of 2022 when investors finally turned bearish, and you could look for a bottom. But bottoms take time. In this case, however, sentiment hit a multi-year low, so when the company gave negative guidance that August and the stock sold off again, just the fact that investors became less bearish signaled an improvement and the bottom for the stock. But you don't have to catch the bottom, because most of the money is made once the company moves into the positive earnings surprise phase and the cycle begins again. For Abercrombie and Fitch, that came in November 2022 with a surprise profit and positive guidance, while sentiment was bearish. Even though estimates were trending higher, investors remained bearish for several more quarters, leaving the stock in the positive earnings surprise phase. In May of 2023, the consensus estimate was a loss of 2 cents per share, and the earnings whisper was a profit of 2 cents. But the company reported earnings of 39 cents and gave positive guidance. The stock rallied 30% on the news while sentiment remained bearish. But before the company reported earnings the subsequent quarter, investors had turned bullish, making the stock an earnings momentum trade. By its next earnings release, the stock was up another 50%, and the crowd was off riding the long trend higher. On the chart for Abercrombie and Fitch, we had a red and green arrow representing the negative or positive earnings surprise, and you should have noticed that each arrow ultimately changed earnings estimates and sentiment. The magnitude of the surprises varies, which means the impact on estimates varies. The quality of the earnings and sentiment are important consideration. That's why we grade each earnings release based on quality of the earnings, the magnitude of the beat, and investor sentiment with the goal of placing the stock in the earnings expectation life cycle. Those with passing grades generally have earnings that are going to drive earnings estimates higher, and the more disliked the stock relative to the likely estimate revisions, the higher the grade. The failing grades are likely in the negative surprise phase, and the neutral grades are viewed to be value traps. Over the past 20 years, it has paid to only be in stocks with passing grades, and those with neutral or failing grades have underperformed the overall stock market. Of course, the grade is just based on data at one particular point in time. It doesn't account for changes throughout the quarter, and there is no quantifiable way to measure everything going on with the company simply based on earnings data. Therefore, we identify where the stock is in the life cycle with the 4 symbols. Even these aren't perfect because analysts often revise their estimates lower throughout the quarter only to see them beat later because, well, that's just what analysts do. But we start by attempting to identify the overall trend in estimates and put those stocks in the left or right hemisphere, and this is marked by the outer ring. We then identify the quadrant based on investor sentiment on that particular day. Therefore, you can, at a single glance, have an idea about where the stock is in the earnings expectation life cycle, which is critical for knowing the likely direction of the stock going forward, as well as how to trade it around its earnings announcement,